What if I told you that while most XRP holders are staring at red candles, watching the market bleed and wondering what went wrong, something much bigger may be happening behind the scenes? What if the real story isn't the crash itself, but who has been buying during the crash? Over the last several months, XRP has faced relentless pressure. Prices have fallen, fear has spread across the market, and countless investors have started questioning whether the long-awaited breakout will ever happen. But at the exact same time, something extraordinary has quietly unfolded. More than 1.6 billion XRP has disappeared from exchanges. Not thousands, not millions, billions. And that raises a question that every XRP holder should be asking right now. If people are supposedly losing confidence in XRP, then who is removing billions of tokens from the open market? And why is this happening while Ripple continues expanding globally, institutions continue building infrastructure, and lawmakers continue pushing crypto legislation forward? Today we're connecting all the dots, because the answers may completely change the way you view XRP's future. Welcome back to XRP Update, your trusted source for the latest XRP news, market developments, and game-changing updates. Before we move forward, do me a quick favor and hit that like button. It helps this video reach more XRP holders and keeps you updated on the latest developments that could impact your investments. Your support truly makes a difference and helps this community continue to grow. Also, make sure you watch this video all the way until the end, because some of the information we're covering today could be one of the biggest clues yet about where XRP may be headed next. You won't want to miss a single detail. Over the past several days, the crypto market has experienced another wave of volatility. Bitcoin pulled back sharply, altcoins followed, and XRP once again found itself caught in the storm. Fear spread quickly throughout the market as geopolitical tensions escalated, economic uncertainty returned, and investors began preparing for more turbulence. For many retail traders, this looked like just another painful correction. Social media filled with panic, predictions of lower prices, and endless debates about whether crypto had already peaked. Yet despite all of that fear, something interesting happened. XRP refused to completely collapse. Even after intense selling pressure, buyers continued stepping in. That resilience has caught the attention of analysts because historically, major market bottoms are often formed when fear reaches its highest levels, while smart money quietly accumulates. The average investor sees panic. The experienced investor sees opportunity. And that distinction may be more important now than ever before. One of the biggest stories developing around XRP right now is the ongoing conversation surrounding the Clarity Act. For years, crypto companies have operated under uncertainty in the United States. Businesses have wanted clear rules. Investors have wanted confidence. Institutions have wanted regulatory certainty before committing significant capital. The Clarity Act has become one of the most closely watched pieces of legislation because it could provide the framework many companies have been waiting for. Supporters argue that clear regulations would encourage innovation, attract institutional participation, and help digital assets move further into the mainstream financial system. Critics point out that delays continue to create uncertainty. Every month that passes without regulatory clarity leaves businesses and investors stuck in limbo. And for XRP specifically, many believe regulatory progress could become one of the most powerful catalysts the asset has seen in years. At the same time, another trend is becoming impossible to ignore. Tokenization continues gaining momentum across the financial world. Major institutions are increasingly exploring ways to bring traditional assets onto blockchain networks. We're talking about tokenized bonds, tokenized treasuries, tokenized real estate, and even tokenized commodities. The numbers being discussed are enormous. Trillions of dollars in traditional financial assets could eventually move onto blockchain infrastructure. Ripple has positioned itself directly in the middle of this transformation. The company has repeatedly emphasized its focus on institutional utility, cross-border payments, tokenized assets, and financial infrastructure. While many crypto projects continue chasing hype cycles, Ripple has spent years building relationships with financial institutions and governments around the world. That strategy may not always create explosive short-term price action, but it has created a foundation that many investors believe could become increasingly valuable as adoption expands. Now let's talk about what may be the most shocking statistic of all. Exchange balances for XRP have reportedly fallen dramatically, reaching some of their lowest levels in years. More than 1.6 billion XRP has effectively vanished from public trading venues. That doesn't mean the tokens disappeared. It means they were removed from exchanges and transferred elsewhere. Historically, when large amounts of cryptocurrency leave exchanges, it can signal accumulation. Investors who plan to sell often keep assets on exchanges. Investors planning to hold for the long term frequently move assets into private wallets or institutional custody solutions. The key question becomes simple: who is accumulating? Retail investors alone typically don't move billions of dollars worth of assets off exchanges. That scale often points toward larger players, institutions, funds, and sophisticated investors positioning themselves for future developments. This is where the manipulation debate enters the conversation. Many XRP holders have spent years wondering why price action often seems disconnected from fundamentals. They look at Ripple's partnerships, technological development, expanding ecosystem, and growing institutional presence, then compare those developments with market performance. The result is frustration. Some believe large entities have been accumulating XRP through over-the-counter transactions and private deals, allowing substantial buying activity to occur without creating major upward pressure on public markets. Whether every theory is correct remains open to debate, but one fact remains undeniable. Institutional investors do not always acquire assets the same way retail investors do. Large purchases often occur through specialized channels designed to minimize market impact. That reality alone means significant accumulation can happen without producing immediate price explosions. What makes this story even more fascinating is the timing. As exchange balances decline, Ripple continues expanding its global footprint. The company remains heavily involved in payment infrastructure, blockchain solutions, and enterprise-level financial technology. Meanwhile, conversations surrounding RLUSD and broader ecosystem development continue attracting attention. Institutions are increasingly exploring blockchain-based settlement systems. Financial firms are testing tokenized assets. Governments are examining digital asset frameworks. Piece by piece, the infrastructure supporting digital finance continues to evolve. None of these developments guarantee immediate price appreciation, but they do suggest that the broader industry is moving toward greater integration with traditional finance. And XRP remains one of the most discussed assets whenever institutional blockchain adoption becomes part of the conversation. Many investors also point to historical market cycles. During previous bear markets, fear often reached extreme levels shortly before major recoveries began. Retail participation declined, trading volumes fell, sentiment collapsed. Yet those periods frequently created the best long-term opportunities. Current market data shows signs of similar behavior. Many retail traders have become discouraged. Some have left the market entirely. Others have shifted their attention elsewhere. Ironically, those moments of maximum pessimism often attract the attention of experienced investors. History doesn't repeat perfectly, but it often rhymes. And some analysts believe the current environment may eventually be remembered as another period when patient investors quietly built positions while public interest remained low. Of course, no discussion about today's market would be complete without addressing global events. Rising geopolitical tensions have increased uncertainty across multiple asset classes. Energy markets have experienced volatility. Investors have become more cautious. Risk assets, including cryptocurrencies, have felt the impact. When uncertainty rises globally, markets often react emotionally before fundamentals reassert themselves. That's why many analysts continue monitoring geopolitical developments closely. Short-term price movements can be heavily influenced by headlines, but long-term adoption trends tend to follow entirely different paths. The challenge for investors is separating temporary fear from lasting structural changes. Those who focus exclusively on short-term noise often miss larger opportunities developing beneath the surface. Another important shift taking place involves the growing focus on utility rather than speculation. During previous crypto cycles, hype often drove enormous gains. Meme coins exploded, social media narratives dominated attention, speculation ruled the market. Today, many industry leaders believe the next phase of growth will be driven by real-world use cases. Investors are increasingly asking difficult questions. Which projects solve actual problems? Which networks are attracting institutional interest? Which ecosystems are generating meaningful activity? XRP frequently appears in these conversations because its value proposition has always been tied to utility. Whether discussing cross-border payments, liquidity solutions, or institutional blockchain applications, the narrative increasingly centers on practical use rather than pure speculation. When you step back and look at the bigger picture, a remarkable contrast emerges. On one side, headlines focus on crashes, corrections, fear, and uncertainty. On the other side, infrastructure continues expanding. Regulatory discussions continue advancing. Institutional participation continues growing. Exchange balances continue shrinking. Tokenization continues accelerating. The contradiction is difficult to ignore. If the future outlook were truly as negative as some claim, why are major players continuing to invest resources into blockchain infrastructure? Why are financial institutions experimenting with tokenized assets? Why are governments creating digital asset frameworks? And perhaps most importantly, why are billions of XRP being removed from exchanges? For longtime XRP holders, these questions feel especially important because many have endured years of uncertainty. They experienced regulatory battles, they watched market cycles come and go, they endured periods of intense volatility. Yet despite every challenge, XRP remains one of the most recognized digital assets in the world. Few projects have faced as many obstacles while maintaining such a prominent position within the industry. That resilience alone has become part of the investment thesis for many supporters. They argue that if XRP could survive regulatory attacks, market crashes, and years of skepticism, then it may be uniquely positioned to benefit if broader adoption trends continue accelerating. The reality is that nobody knows exactly when the next major move will occur. Markets rarely provide clear timelines. Price action can remain frustrating far longer than investors expect. But successful investing has never been about predicting every short-term fluctuation. It's about recognizing long-term trends before they become obvious to everyone else. And right now, several trends appear increasingly difficult to dismiss. Institutional infrastructure is expanding. Regulatory conversations are progressing. Utility narratives are strengthening. Exchange supplies are shrinking. These developments don't guarantee success, but they create a picture that looks very different from the fear dominating social media discussions. As we close today's update, remember that the biggest opportunities often emerge when uncertainty feels overwhelming. While many investors focus exclusively on today's price, others are studying what may happen over the next several years. They're watching legislation, they're monitoring institutional adoption, they're tracking exchange balances, and they're paying close attention to the massive shifts occurring behind the scenes. Whether XRP's next chapter begins next month or much later, one thing is becoming increasingly clear. The story is far bigger than a single red candle or a single market correction. The story is about the transformation of finance itself, and XRP continues to sit at the center of that conversation. So while the market debates crashes, corrections, and short-term fear, keep your eyes on the bigger picture. Because if the recent disappearance of 1.6 billion XRP is telling us anything, it's that someone somewhere believes the future may look very different from what today's chart suggests. And if that turns out to be true, the investors paying attention right now could eventually look back on this period as one of the most important moments in XRP's history.